All right, good morning, everyone, and welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. So, CPI, let's get right into it. We've got quite a bit to cover. Don't forget, if you have liked the past videos I've done in the past, don't forget to like this video. So, get the word out there for your fellow traders and friends to join in on the action. So, CPI. First of all, let's cover what is it, how much. It basically shows how much consumers are paying for retail goods and services. The way that it's measured is you have 26,000 retail outlets, 4,000 housing units in 87 urban areas where prices are collected on 80,000 goods and services. Now, the key measurements that make up the report, you have the housing, which is the heaviest weighting of the report, which represents 42%. Food and beverages, about 14%. Transportation, 18%. Medical care, 8.5%. And then you have the... Somebody says my audio is very feeble. You should be able to hear me. No. Sounds all good on my side here. Just that should fix it. All right. Yeah, no, I was just fixing it. Why do people get so apprehensive? Yeah, turn the audio off. I have turned the audio off deliberately. Should be fine now. Can everyone hear me? Okay, I think we're back. We're good. All right, awesome. So let's get back to it. So core CPI data, of course, excludes food and energy, which is the most volatile part of the report for the CPI print. Now, usually the seasonally adjusted report or the month-to-month report is the one that's preferred. That shows what's going on in the economy without the effects of weather, production cycles, etc. And usually it's because the year-on-year is usually seen as it's not showing you what happened in that month, whether or not there was a big price jump. The month-to-month is seen as a better preferred gauge. But with the Fed's hiking cycle, that's a different story. All the prints are important for month-to-month core data as well, and the headline inflation prints. But that's usually what happens when there is no there's no tightening cycle that's going on. But of course, we're in the tightening cycles. Everything matters. The difference then between PCE and CPI. So some people might get confused. Well, what is the big difference? So the key difference is that PCE inflation, or the Personal Consumption Expenditure Index inflation, places a lower weight on prices for gasoline and residential rents, and focuses on the nation as a whole rather than just focusing on the urban areas. The other key thing about the PCE is that they can chop and change what they measure, whereas the CPI measures a fixed basket of goods. So, for example, if chicken prices are skyrocketing, but the CPI, everyone is buying beef, then the PCE can focus on beef prices rather than just focusing on CPI, whereas CPI is more restricted to that. So there are some differences here and there with the PCE price index and the CPI. Both reports important, but for your traders, it's the CPI report. But in this environment, everything is important in regards to inflation. So how does it affect the markets? Usually when you do see inflation moving up and seeing a healthy pickup, it tends to lead to a strengthening in the dollar, because there is one of the reasons is because, first of all, if prices are slowly going up, then businesses are seeing a healthy pickup in their profits, and that's also linked to the stock market too. But then also the economy grows as a whole as well, because of the pickup in demand and prices as well, and the US makes more money from that. And as I said, with the stocks side, it's the same thing too. So if there's a healthy pickup in inflation, it's the same thing. You see stock valuations start to go higher. But of course, in the tightening cycle, that's a different story. When inflation heads higher, or there is a surprise in the inflation figures to the upside, that can usually lead to a negative reaction or bearish reaction for the stock market, because it means the central bank is going to more than likely continue raising rates in order to bring it down. So the stock market, what you'd usually see is the index futures taking a hit because of the expectation and the speculation that then builds up because of the Federal Reserve needing to do more work to bring inflation down. Particularly for stocks, it's the core data that is quite important. As I said, you have the food and energy part of the CPI report that is the most volatile. So if you strip that back, then you know how strong inflation actually is within the US. But again, all the prints from this report are going to be very important to keep an eye out for. Then bond market, if you do see higher reads in inflation, that can lead to high yields in an expansionary environment, and also in this tightening environment, that we have from the central bank as well. Goes back to the same thing with the stock market, that there is speculation that builds up that the central bank is going to raise rates to bring down inflation. So yields start to head higher, and the bond prices start to head lower. All right, then the previous report for July, representing the June report, we had the index for shelter, which was the largest contributor to monthly all items increase, accounting for 70% of the increase, with the index for motor vehicle insurance also contributing as well. Over the past 12 months, index for all items excluding food and energy rose 4.8%, with shelter accounting for a significant portion of the increase, along with motor vehicle insurance, recreation, housing, household furnishings and operations, and new vehicles as well. Then where is the economy at the moment? So what are we, the reason why we look at where the economy is at the moment is to get an overall sense of what are the how strong is inflation within the US overall, and what are the other inflationary pressures that are being added that could add to the CPI report or have an influence on the report. Non-farm payrolls, what we had recently was 187k compared to 185. The unemployment rate was a tick low at 3.5 compared to 3.6. Have average earnings year on year, which is unchanged at 4.4%. Employment costs was at 1% compared to 1.2. The PC price index was at 3% compared to the prior 3.8. The core data was also lower at 4.1 compared to 4.6. ISM manufacturing prices paid ticked higher to 42.6 compared to 41.8. Services prices paid also ticked higher to 56.8 compared to 54.1. Productivity rose to 3.7% compared to a prior minus 2.1%. Import prices also rose to minus 0.2% compared to minus 0.6%, as did export prices to minus 0.9% compared to minus 1.9%. PPI headed lower to 0.1% compared to 0.9%, and core PPI also headed lower as well. So all you can see here, so non-farm payrolls is one of the key reports, of course. If there are more jobs that are being added to the economy, that increases the likelihood of more spending. If there are more jobs that are being taken up by people, of course, if they have more money to spend, or if they have money to spend, then that drives the demand up for goods and services within the economy. And then that can have a knock-on effect on the inflation print itself. Of course, there are other factors that affect inflation too, such as supply chain issues, or making the goods or providing the services themselves as well. But that's one of the key things to be aware of. The average earnings year on year, which is actually forecasted to tick lower with the inflation, with the non-farm payrolls print, it stayed at 4.4%. So there might be some pressures within the US economy that are keeping analysts thinking that inflation might tick up to 3.3% for the year on year rather than lower. So they're thinking that the inflation, the pressures that they have, what the US has in the economy at the moment isn't going to be enough to keep it down, and that's why you have some Fed members that actually a couple of Fed members that still call for a need to raise rates again at the next meeting. All right, so the triggers then for the economic release. So the month-on-month, according to economists, they're expecting a high of 0.3% with a low of 0.1. Year-on-year with a high estimate of 3.4 compared to a low of 3.2. Core month-on-month with a high estimate of 0.3% with a low of 0.1. So what we've got to understand is that if the data, what we saw last time, if all the data is lower than expected or higher than expected, then you'd expect a strong market reaction, whichever way it goes. Okay, you wouldn't get a whipsaw reaction. The only time you would get that, usually, or what has happened in the past, and if you have been looking at the deviations sheet, if you have deviations and ranges, if you have access to that, again, that's completely free, and I'll share the link to sign up to get that. You will notice that when data is mixed, then it becomes the picture becomes unclear, or the direction becomes unclear, and the markets are trying to go one way when one way thinking that okay, inflation pressures are coming down, and the other side of the market thinking nope, they're still going up, or they're not coming down as fast as economists had expected them to. Hence, you get a mixed reaction when data is mixed. So ideally, you're looking for data to go all in one direction, whether it will be higher or lower, because it gives you a clear indication, right, inflation is going down or is going up. But then, of course, compared to the forecast. But then what would also be another added bonus to the strength in the markets would be whether if the actual figures are higher or lower than the previous figures as well. So that's also got to be that's also one thing we've got to be aware of. So if the forecast is for 3.3% for the year-on-year figure itself, okay, barring the other figures, if it does, let's say, if it does smash it and goes higher than, let's say it goes lower than 3%, that could add some positive momentum to the stock indexes and some negative momentum or more of a bearish reaction for the dollar. But then again, as I said, you want all the data going in one direction together. If they don't, then it becomes a bit harder to try and trade the economic release itself. And you get more of a whipsaw reaction, which nobody wants to do. Unless that's what you like, then be my guest. That's totally down to you. Jacques says, hi, I've signed up last time but never received it. Check your email. If you might want to double check your spam. But in the email, you should have two links, one for the live streams, and then one for the ranges and deviations. And that should then open up to a new tab. And then you should be able to see the ranges and deviations. Okay, so then also the other point, so with the core year-on-year, with a high estimate of 4.8% and a low of 4.6%. Sentiment and views. What is the current feeling about the inflation data and the economy in general? So you had Morgan Stanley's Wilson talking about the boom and bust and cautioning on impending earnings recession due to declining inflation. Falling inflation is already impacting sales and earnings growth, with producer price index showing only a 0.1% increase in June. So what I was talking about earlier is that when you're not in a tightening environment and the central bank is looking to maybe support the economy instead, if you do get disinflation and then it turns into deflation, that's going to be bad for the stock market, because of course the valuations start to head down if businesses are making less money. That's one thing to be aware of. So this is what Morgan Stanley's Wilson is talking about, that at some point when the central bank has finished with their hiking cycle and the focus then shifts to whether the US economy dips into a recession or how strong it is if it stays afloat. Then it becomes on, is it growing? Or is it, how strong it is it growing? Or how weak is it becoming? And then the prints for inflation become less important, because then the focus goes to the job market instead. Okay, how many people have, how many jobs have been lost, and what does production look like? What is the manufacturers? How is the manufacturing sector coping? And also the services side too. Then the shift goes to that, but we haven't seen that yet. We're yet to see that until the Fed decides to pivot or talks about pivoting, maybe. But we haven't seen that yet. This is also quite important too with the commodity side. Oil prices could add pressure to inflation. So some analysts believe that if oil is at or above $83, that it could add 0.3% to August's monthly inflation, which is also going to be quite key for markets when they try and price in where they expect the next inflation print to be, and also what the Fed's rate hiking path is going to look like in the future as well. So if you haven't come across the fundamental side, if you haven't delved deep into the economic releases and why they're important, how they can affect the markets, now's the time. Well, I mean, maybe last year would have been great, but any time is always great to have the information and the wealth of knowledge to be able to stay on top of why these economic releases matter, how they affect the markets, and what it could mean for the future as well. That's not me saying don't watch this. It's still useful. And I'm not trying to shoot. I just shot myself in the foot, didn't I? Anyway, so carrying on. So you had Deutsche Bank's chatter that said that if the Fed can bring down inflation without triggering a recession, that the S&P could go to 5,000. So that's another thing to be. It's not the fact that the S&P is going to go to 5,000 or could go to 5,000 as the important part of that. The important part of the comment is them talking about whether or not the Fed can do their job without putting the US into recession, because of the quick and big amount of rate hikes that the Fed has done over the last year or so in their rate hiking cycle, and also the other central banks raising their rates too. Of course, that also has an effect on how the US is affected too, because everyone's so interconnected through the globalization system that we have. We're even more connected than we were, back in the 2007 to 2009 financial crisis. So that's also another thing. That's the key thing you've got to take away from it, is that if inflation does continue to go higher, then you'll start getting more speculation that the US might go into recession, and that might mean that there is more volatility that creeps into the markets when these prints come out. Not just the inflation print, but also the other key prints as well, with non-farm payrolls, the manufacturing side, services, what is consumer spending like with retail sales, or the consumer spending report from the GDP data that comes out the day before. How does that look? So they're all different. There are other different factors that we have to be aware of to understand that we have to get the full picture to kind of give ourselves the best, let's say, or give ourselves that edge in knowledge. You had SocGen's Rajappa that said that if data disappoints with the front end pegged to Fed expectations, that's the 3-month, 6-month bill auctions, those short-term maturities on the yield curve, then a rally in treasuries would result in the flattening of the yield curve. Let's say that off of the back of this data that the Fed or the swap market decides, say, okay, the Fed might decide to pause at the next meeting, that they don't need to raise rates if, and this is a personal opinion, so don't take it as your own, if the inflation data is weaker than the prior figures, not the forecast, the prior figures, because inflation is forecast to tick up for the CPI year on year. Just for the CPI year on year, the core data was originally was expected to come in as expected at 4.8%, but now that's gone down to 4.7%. So the year-on-year data, ideally, regardless of what it is, you'd want the previous figures, you want the actual data to be weaker than the previous figures, to then say, okay, inflation is continuing to tick down, and maybe the Fed doesn't have to do that much more work, and that could mean a pause. Again, that's just my speculation on what the Fed will need to do to pause and then to go the other way later on down the line, if it is in early 2024, late 2024. So, Fed and government views then. Fed's Powell said there is a lot of uncertainty about the market outlook at the next meeting, let her know the next year. Bostic have said that the Fed is on trajectory to get to 2% inflation. Bowman said that we should stay ready to hike rates at a future meeting if data shows inflation progress has stalled. Fed's Barkin said inflation remains too high. Fed's Harker says our forecast is not that inflation might spike back up. Okay, market pricing then. We've got about less than 8 minutes till we get the release. Money markets trimmed bets for peak ECB rates after use inflation data. So again, the volatility that creeps into the markets is what we need to be aware of. It doesn't just affect, the US markets, but of course it affects everyone else too. So we have to be cautious of that. Fed swaps on July 20th priced in high odds of another rate hike after July. 25th of July, Fed swaps will resume pricing in 50% odds of a post-July rate hike. So this is the last print that we had last around the real market reaction. It's important to understand. I mean, this is quite simple. All the data went in one direction. It went down. So from that data, you had a nice clean reaction from it. Okay, so from that data that was lower than expected, you had the dollar yen that the dollar that dipped. Let's say had a bearish reaction there. Gold ticked up. You had the S&P also moving towards the upside. So the stock index futures love that data. So what I'm trying to say here, again, like I said earlier on, is you want data to go all in one direction. So then you get that there's a stronger probability of a cleaner reaction rather than a more of a choppy reaction if data is mixed. So that's the key worry here. But it doesn't mean the market could take, let's say if some of the bits of data are as expected, and I'll kind of, let me skip forward a bit. Grab it up. There we are. Yeah. Okay. Let's get it out there. Let's get it out of here. Let's bring up the deviation sheet and ranges. Here we are. So yeah, sometimes in the past where you've had it where the data, where not all the data goes in one direction. You might have bits of data, as you can see here on the deviation sheet, where you might have a couple of bits that are as expected, but then the other two are heading in one direction. You could still get a clean market reaction from it. But ideally, to see a bigger, stronger reaction, you'd want data going in one direction. So sometimes what you might have seen it here, where, maybe sometimes the market sentiment is that inflation isn't coming down fast enough, and there's only one bit of data that is showing an increase, or whether the data is, all the data is still showing an increase and there's a couple of bits that are not, then it becomes a bit harder to kind of predict or to kind of see which way the market is going, and then you're reliant on which way the market wants to go after the initial rummaging around the markets have happened. But so what we want to double check and what we want to keep an eye out. So if we're keeping an eye on what has the biggest market reaction in regards to the currency pairs, we can see here with the dollar yen, so that it has consistently had the biggest market reaction. So now that we have talk of maybe the Bank of Japan being more hawkish with their monetary policy, it depends on what that, and of course that news has been that's Bank of Japan becoming more hawkish with the monetary policy as a potential, been going on for a couple of weeks or so now, or it was a couple of weeks ago. That has a potential to mean that the market reaction might see a little more moderation if you also see the Bank of Japan starting to become hawkish, and if they do decide to start their rate hiking cycle further down the line. But consistently, the dollar yen has seen the biggest market reaction. Then, of course, here you can see on the S&P, so you can see that the initial market reaction. So if you guys have signed up to the deviations and ranging sheet, so this figure here represents the initial market reaction going to the wick of the candle, capturing the initial market reaction. The figure in the brackets here, the first one, shows you the movement 10 minutes after the release. Okay, and this new bracket that I've added in, of course, taken on the criticism or taken on the comments that you guys have given me, this is also the market reaction 30 minutes after the release. Okay, so you can see here that, and you've seen in the video, that the market reaction in the stock index futures lasted a little bit longer than it did in the currency pairs. So that's one thing to be from what we had seen last time round. Okay, so you can see here that the dollar yen, after about 30 minutes, had nearly, reversed all of its losses that it made off of the initial market reaction. It was still up by, still down by 20 and a half pips. But if you're comparing it to house, if you look at here, so you can see here with the NQ that after about 10 minutes of trading, it was up, still up 300, it was up 373 ticks. And after about 30 minutes of trading, it was, it was up by 359 ticks. The difference, or, if we compare the difference here, that the market reaction held up a bit longer compared to the dollar yen and some of the other currencies as well, just from what we'd seen last time. So not to say that it's going to happen again, but just historically from the report that we'd seen last time, that's what had happened. And I'll be doing more of the 30-minute market reactions for these economic releases as well. So yeah, we've got 1 minute now, or less than a minute till the data. So let's get that going there. Okay, we've got about less than 30 seconds. Alrighty, let's get TICKSTRIKE up and running. See what this data does. Okay, 10 seconds. .2%, 3.2%, lower than the forecast of 3%. Also CPI month on month, 2%, as expected, and core CPI year on year as expected, 4.7%, core month on month as expected as well, 2%. Okay. As I said, so the headline figure with CPI year on year at 3.2%, 3.2%, lower than the forecast of 3.3%. Okay, so seeing that positive move from the S&P, from stock indexes there, gold seeing positive moves as well. Okay. All right, let's see what the rest. So the NQ is still pumping. Okay. All right. Right, and dollar taking a hit there. So not as strong as a report as we had last time round. And when I say that, I mean with the figure that all the rest of the data was in line with expectation, but you only had the one print with the CPI year on year that was weaker than the forecast. but not the prior, of course, which again is going to be a key thing for the Federal Reserve to be aware of too. That, inflationary pressures that they might be not as weak as they might want them to be. So again, but the dollar yen still taking a hit. Gold there going up. Bond prices, bond futures, that's a 2-year. Let's look at Bitcoin. Let's get that up there ready. Okay. Okay. Let's see. Okay. A bit of a jump there. All right. Okay. All right. So a bit of a reversal there. So like I said, for a strong reaction, you'd want all the data going in one direction. You had that one point of data that was weaker than expected, but it wasn't amazing. It wasn't a report that blasted around other markets. All right. Let's do some measurements here. I have a feeling it's not going to be as strong as... It's definitely not going to be as strong as the last one. Yep, no, not as strong as the last one. There we go. So 66 ticks towards the upside there. Okay. All right. Gold. Let's see what we did here. So it's 76 ticks up. Right. Dollar yen. Oh, no. Oof. Dollar yen. Yeah, about 20 pips down. All right. Okay, it's a bit of a mixed match. So, bond prices, 2-year bond prices, futures there. Having a bit more of a whipsaw reaction, not a clean reaction there to the data. Okay. All right. That so how do you get hand on the deviation sheet? So all you got to do is sign up to the MACROACE mailing list here, and all right, there you go. That's the link to the MACROACE mailing list. Again, as I said, that's completely free. You can have access to the deviation sheet there, and also the ranges for the week ahead as well. One thing to also be aware of, so part of the MACROACE mailing list, you get the link for the live stream for the week ahead, and only the ranges and deviations. But the other thing, you get a little short summary of what to expect in Asia, the US, and European session of the releases that might be coming up. What is the sentiment surrounding them? It's very short and compact, so it's not filled with a load of information or charts or graphs or anything like that, because I go through and talk to you guys in detail in the live stream about what the sentiment is anyway. That's affecting the markets and how that links to the CPI print or the releases that I'll be doing as well. So I hope you found the information useful so far. If you haven't found the information useful, again, that's what we do, providing the information for you guys to then be able to use it in your own way. Then don't forget to like the video, subscribe to the channel, get the word out there, brother. And I will see you next time. So remember, next week there won't be any economic releases that I'll be covering, but I will be talking about what is risk on, risk off trading. What does that mean? Okay, how does that affect the markets? Why is it important for traders, particularly day traders, to understand how the markets move, and what are the events that have caused or have affected the markets because of the risk off and risk on sentiment that has occurred? So these are the things that we need to be aware of. It will be a live stream that I'll be doing. I'll get the link up here for you. I should have got that bit ready. Let me get up here. Right. There we go. All right. There we are. That's what I wanted. Right. There we go. Okay. There we are. That will be the link for next week's video live stream that I'll be doing August 16th at 11 a.m. Eastern time. Again, talking about risk on and risk off trading. What does it mean for the markets? How has it affected the markets in the past? And again, why it's important for you to master and understand it in this environment as well, and in any environment that you're facing. Alrighty, so that is MACROACE. Also, don't forget to subscribe to the FinancialJuice newsfeed as well. Now, FinancialJuice, it's a live voice and text service giving you up-to-date information on what's moving the markets and talking about why it's moving the markets, all here in one place in our FinancialJuice newsfeed. So you have a live voice, okay, which is here, and you have a live newsfeed here as well of the text headlines. And on the left hand side you have the economic calendar. Again, that's live in real time as well, giving you the data for the different economic releases that we have coming up or have already come out, so you can see that there as well. So what's the whole deal for having a live voice and text service? Well, firstly, let me say this: the big boys, the big traders, the hedge funds, okay, the professional traders, the guys who are doing this day in, day out, they're sat at the desk in a big group of other people, right, together. What they do is they have a live voice and text service because they know that fundamental news moves the markets, right? And then they can manage their risk. And they can also jump on potential trades that could appear to them because of a headline that's appeared, right, from listening to a live voice and text service. So that is a key thing. So for retail traders, you might not, if you're a retail trader, you might not have heard of it. You might have come across it. You might have heard of it and thought, I don't know, don't need it. Well, there is a very good reason as to why it is needed, because there have been headlines, like the Fitch Ratings headline, right, that came out in the past. That caused the S&P to go to tank in the Asia session. Okay, important news like that, for you can see the market going down and you can trade it, but then do you understand why you're trading it? That's another thing as well. With the news, you'll be able to understand what's going on and why the market is moving in that way. If it's really bad news, you might stay in that position forever. I'm not saying that's what that's what you should do, but that's, again, it's the trading opportunities that are presented, managing your risk and understanding and knowing what's going on. And that's what the big boys do. They want to know what's going on. They want to know what risks that they're facing within the markets or opportunities that could be presented to them. And yeah, it's not easy. It's a difficult thing to be able to use a live voice and text service and then be able to make actionable trades if you're not used to that sort of thing. But let's say, if you say, okay, I want to dip my toes, then you can sign up to FinancialJuice and you can get the free version or the live version of FinancialJuice, which has a delay to the site itself. As a whole, you get adverts that are played, and you don't have access to the news desk to ask about what's going on within the markets, why the market's reacting in this way. then that's again, it's still useful for you to have a little play with. But again, as said, so that's live. That's FinancialJuice, a live, real-time voice and text service that is provided to you. If you want to go to the Pro version, make sure you have an account on FinancialJuice first, and you'll see a little button where you see the FinancialJuice Pro logo in the top left of the screen that I'm sharing with you guys now. And then you can click Go Pro. Make sure you have verified your account first from your email. Select your subscription, go back to the site, to the news feed, log out, log back in, and that will act as your verification, and then you'll be able to see this beautiful site that I have here of the news feed. Okay. Right, so that's FinancialJuice there. So TICKSTRIKE. If you have heard of TICKSTRIKE, then you will understand it's you know, you'll be able to listen into and be able to look at how strong the order flow is within the markets. The other thing is, or another way to think of it is, how strong is the buying or selling momentum, okay, within the different assets. That includes Forex, stocks, futures, crypto, internals, ETFs and ETNs as well. So that's one thing about TICKSTRIKE, is that you're able to look at those different asset classes and be able to tell and be able to see how strong the buying or selling momentum is. So let's look at an example here. So with the NQ and the S&P, so if there's a little bit of buying or selling momentum here, so let me pull up this box. So this box here is what we call the ticker. And this box, this number here represents the strength of the buying or selling momentum. Okay, plus symbol showing you the buying, the minus showing you the selling side. Okay. Now, on the NQ, so what you can do here is you can adjust the level or sensitivity. So what do I mean by the level of sensitivity, and what do the numbers mean? So the range goes from 1 to 15. 1 is the most sensitive to market reactions. So whenever you see, as you can see here, whenever there's a little bit of buying or selling momentum that pops off, if it meets the criteria, then TICKSTRIKE will give you a visual and audio alert for that. Or you can choose whatever you want. You can have a visual, audio alert, whichever way. We'll have both. Then when you slide that all the way up to 15, and you can kind of chop and change it to wherever you want it to be. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs within the markets does TICKSTRIKE give you an alert to that there. So again, if you're a day trader, you're scalp with the markets, again, that's another tool to add to your arsenal for your trading. And there is also a 7-day free trial of TICKSTRIKE as well. Now we do have the data on. We do have it on the site as well. Actually, you have a free version here, but it's limited to only those 4 different assets. Okay, and the sensitivity is stuck as well, and you can't chop and change that. But if you want to get used to how to use TICKSTRIKE, then have a little play with that first before you sign up for the pro version of that, the full version. Somebody said, is this positive for the dollar? Well, if inflation, well, this is the thing. So it's this, you kind of got to take what the market's taking in as, you can't really predict if it's going to be positive for the dollar in the long term, if that's what you're thinking. Okay, in the long term, let's kind of break this down. What are the different scenarios? Okay, let's from the figures that we had. If you really want to kind of delve into whether it's positive or negative for the dollar, 2 different scenarios. You had inflation, the year-on-year inflation that was weaker in the year-on-year figure, wasn't weaker than the previous figure, weaker than what the markets were expecting. So there is a potential for markets to believe, actually, here you go, Fed swaps price in lower odds of another rate hike this year. There you go. So whenever the speculation rises in the speculation of Fed raising rates, the dollar sees an appreciation usually. Okay, but off of the back of this is what's happening in the markets, that the pricing in lower odds of another rate hike this year. So that could be negative for the dollar. If they were starting to price in rate hike, another rate hike this year with the inflation data, then you might see the dollar continue to go up. The flip side, or the different scenario that's presented, is that inflation, if we kind of go back to the data, inflation is sticky. Or let's say inflation is sticky. There's a bit more work to do in these areas. Although the core data, was lower than the prior figure, it's still sticky. It's not coming down fast enough. And what that could mean is that the Fed continue raising rates, and you see the dollar start to creep up higher. But that's another scenario. But we can see so far is that isn't, potentially, you're seeing more of a mixed reaction initially, right, from the data itself. It didn't sustain its initial move like it did last time round with the last CPI print that we had from the BLS. All right. Tony D says Tony is the best. Thank you very much. All right, that is the live stream done for the day. Also, don't forget, actually, so we have the, we also have unusual activity. So if you come across it before, so unusual activity, if you like trading high probability stocks, futures, FX, and crypto breakouts in real time, then you can sign up to that. There. All right, ladies and gentlemen, don't forget to like the video, subscribe to the channel, get the word out there if you found the information useful, and I will see you guys next time. All right.